morning or good afternoon, depending upon where you are in the world. What I thought I'd do today is a very quick roundup of the latest investment outlook from one of our favourite market commentators, Tom Elliott. So there's a lot of information in this one. It's been a really busy fortnight, so I'm going to try and blitz through it, do it super fast so that you just get the headlines. Fingers crossed that works out. So he's going to look at 5 key areas. He's going to look at number 1, market sentiment. He's going to look at number 2, shadows to be aware of is what he's calling that. Number 3 is the latest OECD report and sector rotation. Number 4, he's looking at the latest EU stimulus package announcement. And number 5, he's looking at Brexit and Sterling. Okay, let's dive right in. Number 1, market sentiment. On the whole, pretty positive at the moment, isn't it? So in the US last week, we had markets all-time highs. And if we look at industrial commodities, so the likes of iron ore, copper hitting 7-year highs is a really good indicator of economic activity in the future, i.e. people will be ordering those kind of raw materials in order to build projects or make things that are going to happen 6 months, 12 months, 18 months from now. So a great economic indicator there, all positive. Area number 2, shadows to be aware of. I'll break this down into 3 areas. A, he's looking at fiscal support. B, vaccine rollout, or rather the vaccine rollout success. And area C, he's going to look at no deal Brexit. Okay, so let's look at A, fiscal support. So what he's saying here, and again, we've mentioned this in previous videos, he's saying that the fiscal support from government needs to be there and in place until an economic recovery is complete, which is probably going to take 10 years, I would have thought. So it's not just a case of having it there now and it getting pulled in the short term. He's saying economic stimulus needs to be a feature of the full recovery and it can't be pulled until the end. If that were to happen, then he sees that as a risk, a shadow to be aware of. B, vaccine rollout success. A hugely emotive and controversial issue, and my job is not to give my opinion on what I think about vaccines, but you've got people that are anti-vaxxers and don't believe in them whatsoever, and then you've got people that think it's, you know, the cure to this entire pandemic problem. And Tom's view is that it's a bit of a one-in-all-in solution, right? If you have different nations and different people within those nations that think different things and have different strategies, then it probably just won't work at all. Who knows what 2021 is going to look like? Will you need a vaccine certificate to get on a plane? I don't know. Will there be certain vaccine-approved corridors? I don't know. However, he's saying that, you know, there are stumbling blocks in that process if it is not a sort of globally accepted path. C, no deal Brexit. This seems to have been rumbling on for ages, doesn't it? We had Brexit climbing over the last sort of month or so, which is a good indicator that people think there will be a deal. However, as we all know, there's so many undercurrents and undertones within the Brexit situation that there's a good chance that there won't be. Tom obviously sees that as a bit of an economic risk, particularly for the UK. Flicking onto World Trade Organization tariffs, just Tesco alone have said that the cost of food would go up 3%. So there are connotations economically to a no-deal Brexit, and they're not necessarily great in many ways. Okay, area number 3, the OECD report and sector rotation. So the OECD report, the last one on the 1st of December, was super positive, which is great. If we compare it to the one that they released in June, their last one, now they're saying, if we take the US as an example, that the US economy is going to shrink by 3.7%. So it's still shrinking, but in June, they thought it was going to shrink by 8.5%. So less than half of what they were saying only 6 months ago. That's a big improvement. And they're even saying that China is going to get growth in 2020 of 1.8%. Okay, it's not as we've seen over the last 10-15 years, but it's still a positive number, and that is it's spurring on that whole sentiment driven sort of market that we're seeing at the moment. If we look at the sectors within those markets, and again we've talked about this before, Tom sort of mentions that tech has underperformed a little bit compared to other areas, and there's this sector rotation sort of happening. Tom doesn't like the word rotation. Why? Because that implies that the money would be leaving tech and entering utilities, energy, banks, etc. But it's not. because the Nasdaq is still, doing really well and at an all-time high. It's actually coming from cash and government bonds. So it's not so much as a sector rotation, it's just that the tech sector hasn't grown as much as the others in the last sort of month or so, but it has still grown. So he doesn't like the word rotation. Area 4, the EU stimulus package announced 750 billion euros, an incredible achievement and a huge sum of money, right? But what it hasn't been announced as is a sort of COVID recovery fund. It's a medium-term economic recovery pool. And actually the peak of spending won't be until 2024. Markets have liked that. They like that future medium-term view and a progressive recovery out of this recession. Area number 5, Brexit and Sterling in particular. So Sterling's been on a big rally in the last sort of month or so. It doesn't seem like that long ago that Sterling was sitting at 120-ish against the dollar, and now it's at 135. That's a big jump. It's probably risen. There are two sides, right? The dollar has weakened, but it's probably risen on the back of the premise that a Brexit deal will occur. If one doesn't, then you have analysts saying that you could see sterling fall 15%. Those who have listened to me before will know that I always sort of maintain the stance of saying trying to predict currency markets is a bit of a fool's game. There's over $5 trillion a day flowing through FX markets, and everybody has their own agenda. So trying to predict that market is incredibly difficult. However, the general consensus is that no deal equals weaker sterling. Let's see what happens. Okay, I hope that was useful. If you found any form of value from it at all, please like, subscribe, share, tell people about it, etc. This will probably be the last one that I do before Christmas and New Year. So if that's the case, I wish you all a very Merry Christmas. And let's hope that 2021 is somewhat different to the 2020 that we have all just lived through. Take care.